Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is our latest offering, What's Hot, a show that focuses on what's the latest buzz on the D street. Well, IPO space clearly in focus. Two new debut stocks now making a entry into the stock exchanges after having their IPO subscribed fully in the last week or so. We have two companies that are opening. That's Corona Remedies. It's seen a substantial uptick as far as the listing is concerned. Remember, the stock is now hovering at 1447 odd levels. That's over a 36% premium to the issue price of 1062 that we saw. A substantial move is what we've seen for Corona. You are actually able to see the live visuals from the NSE at this point in time right there. On the other hand, when we look at the Wakefit company, the innovation company from Bengaluru that's focused on mattresses and furnishings as well. That's seen a flattish start on the stock exchanges after having its IPO getting fully subscribed right there. Both the visuals are on your screens for Corona as well as Wakefit, and therefore you do see a flattish listing for Wakefit. 190 against the issue price of 195 is what we are trading at as far as Wakefit is concerned. So we are going to be focusing on both these to help you understand what should be your next step in understanding how should you be approaching both these stocks right there as far, as they begin their stock market journey today. Of course, from the pharma space, it's Corona Remedies that's definitely seen a substantial premium. So to all the investors who had got the allotment of the IPO, it's definitely a celebration because you have now a 36% premium there. But for Wakefit, it's now trading at 180.9. It's actually slipped even after getting listed. So you are seeing a 7.5% discount on this one. Of course, on the show, we are going to be focusing on understanding. We have our guest also now joining in, Mr. Sudeep Bandyopadhyay, the Group Chairman of IndiTrade Capital, is now joining in. Warm welcome to you, Sudeepji. Good to have you with us as always. Let's start off with the first view on the new debut stocks, Wakefit as well as Corona. And Corona, of course, has seen a 36% premium listing. Wakefit has slipped now 7% after getting listed on a slightly weaker note. What would you say on both these companies, sir?
Well, I would say it's pretty much on the expected lines. I think the kind of subscription and the excitement and the grey market trading which was happening, Corona was definitely a favored stock. And I think we know the sector in which they are operating. And it's been a well-established company with a track record and, and a history of performance. And I think there is absolutely no question about the kind of fundamentals of Corona. So yes, investors who have got the shares can remain invested. I think this is a sector where they will see a lot more upside, lot more excitement going forward as well. As far as Wakefit is concerned, the company has pivoted from the pure mattress company into multiple other things which are adjacencies. I think they are trying to establish themselves as a home solutions company, and they want to compete with other home solutions global brands. It's a good journey to begin, but I think they are yet to prove themselves in many of these segments. So it was kind of a experimental kind of an approach as far as their incremental businesses are concerned, and I would say that it will take some time before things do get stabilized there. The discount was not expected, but I'm sure there is a lot of selling happening at the counter post-listing because people who have got allotment must be trying to get out. And that's why we see this selling. Things will stabilize going forward, but I don't expect anything major to happen. The issue was not very attractively priced as well. It was reasonably fully priced, and will take some time before it starts recovering and gaining momentum. They have to perform in the market. They have to perform as far as their financial numbers are concerned, business is concerned, and demonstrate that to the market to deserve a better valuation.
Absolutely. So that's as far as the new debut stocks are concerned. The upcoming IPO will also be a space that we have to watch out for. Again, this week we will see Nefrocare Health IPO getting listed. We are also going to be seeing the share allotment, which is likely today itself. The IPO was subscribed about 14 times. In the retail category, we saw 2.3 times subscription and about 26 times subscription in the QIB category. NI has also subscribed at 24.7 times as well. So the subscription figures were strong. And from the healthcare space, we also have Park MediWorld IPO as well. Again, for the share allotment, it's likely today for all of those who had applied for this IPO. It was subscribed about 8.5 times completely. On the retail category, of course, 3.3 times, 12.7 times for the QIB category, whereas 15.9 times of subscription was seen in the NI category. So both these healthcare world IPOs also got good subscription levels. Time to see whether these will also continue to see substantial listing gain and also perform in the long term. How would you look at these two healthcare related stocks, sir? Park MediWorld as well as Nefrocare?
Nefro is a very niche player, and it's a niche which is by and large very unorganized, and they're trying to be probably one of the first organized player in this space and trying to consolidate the industry. This is a good space to be in. The demand is humongous and is continuously growing. And I believe that from a long-term perspective, Nefrocare is a good stock to invest in. My suggestion would be that in case somebody is interested in buying, just don't rush into buying the moment it's get listed. Let things stabilize a bit and then buy from a long-term perspective. As far as Park is concerned, Park Medi is concerned, I would say at this stage, probably it's better to skip. Let's wait and watch how things move going forward. It's in a space where there is competition, there are people getting into it, and a lot of consolidation is happening. Not saying that the sector will not do well. Sector will definitely do well, and I'm sure Park Medi also will start doing well, better. But at this stage, I would say it's better to avoid.
Okay, got that. So that's the IPO space that's taken care of. Let's focus on the secondary market also now, viewers, and get you a sense of as to how to look at the markets right now. We're again seeing, some nervousness at the higher levels, 25,942 right here, 105 points lower in trade. So even as we inch closer to the end of the year, the Santa Claus rally is truly missing. We did have a touch and go moment quite a many times as far as 26,000 and probably the record high levels are concerned as well. But we continue to see that, selling pressure emerges at those higher levels, and the strength is lacking at those levels at this point in time as far as the markets are concerned. What's the sense that you have into the markets as we are getting ready to enter into the new year, sir?
Well, I think we are seeing time correction in the market, which was bound to happen. Look, in spite of all these corrections and, basically hovering in a range for quite some time, the market is not, Indian market is not cheap. The valuations, I would say they have corrected from the levels where it was in terms of multiples and have become a shade better. But I think we will probably see a little more correction in terms of valuation, which will happen through time correction. And this is pretty much what we are seeing getting played out. Remember, there are no fresh positive triggers in the market at this stage. The biggest trigger for which I think everybody was waiting was India-US trade deal. Unfortunately, that hasn't yet happened, and I don't see it happening in a hurry. The government of India is very clear. They won't do a deal under duress and under some kind of a pressure. That's the right strategy to take. Unfortunately, the foreign investors, FIIs, are somehow psychologically linking the trade deal to investment into India. And that's our assumption. And that's why we are not seeing FIIs investing in a meaningful manner in Indian market at current levels. In fact, their FII holding in Indian stock is at record low levels. And as and when the trade deal happens, I think we will see a flurry of activity from FIIs, which will take the market to the next levels. But at this stage, lack of trigger, I think, is kind of bothering the market, and it's just hovering in this particular range around 26,000. Give or take plus minus 100, 200 points, it's moving. That's where it is, and I think that's exactly where it is going to continue, irrespective of the domestic factors and domestic, little bit of drip of positive news which is coming in terms of incremental reforms which the government is coming out with.
Okay, fair point. One of the other key impact of all of these reasons, Sudeepji, that you've mentioned is also being seen on the rupee, which has slipped to an all-time low as well today. In fact, it's now at about 90.63. That's the weakest that we are seeing on the rupee. And these record levels have been actually inching even higher as we see over the last 1 week, 10 days. Of course, like you pointed out, the foreign fund outflows, the US-India trade uncertainty, the widening trade deficit, these are all weighing on the rupee at this point in time. RBI interventions also seem to be less aggressive at this point. I wanted to just understand as to how should an investor look at the rupee right now? Why is the RBI not being as aggressive to contain this fall at this point? And what's looking ahead for the rupee going forward?
Well, I think to an extent, if we look at it from a different lens, I think from a Government of India and RBI point of view, letting the rupee fall to an extent is, par for the course. We want our exports to remain competitive, and in a scenario where the kind of tariff which has been imposed on us, the one way to ensure its competitiveness is to let it depreciate to an extent. And I think RBI is probably kind of holding back and letting the rupee depreciate a little more. Look, 2-3% depreciation annually is an accepted target. But I think depreciation beyond that is being allowed now to ensure that India remains competitive overall. And that is probably a conscious strategy which the government has adopted. Otherwise, probably this wouldn't have happened. As far as the apparent reasons which some of you counted, FII outflow obviously is adding to the pressure, and and a lot of other issues which are small but niggling are also adding to the pressure on the rupee. I don't want to belabor on those points, but the fact is RBI is not intervening the way they could have. Clearly indicates that the government is tacitly approving the depreciation to ensure export competitiveness.
Okay, got that. When we look at the rupee depreciation, it is always the export-oriented sectors that tend to get benefited. Do you think this is the time that traders and investors can actually take benefit of the falling rupee and maybe take a fresh view on the export-oriented sectors, maybe IT, pharma, textiles? How are you looking at such sectors at this point, sir?
Well, I think IT definitely benefits. We all know that on an average, 50% plus of India's IT companies derive their income from US. 50% plus income comes from US. Rupee depreciation definitely helps them in a big way, and it straight flows into their bottom line. So yes, you may see some knee-jerk reaction as far as IT companies are concerned on the back of this depreciation. Obviously, their P&L will be looking much better come Q3 and Q4 based on the depreciation. But these are short-term phenomena. We have to look at the fundamentals of the industry and the way the industry is moving before we take a call. So I don't think I will rush into IT. Some of the other sectors which indirectly benefit in a big way, like two-wheelers. Now, this is one industry which now is heavily exporting, whether it's Bajaj Auto, TVS, even the others are exporting in a big way. And this rupee depreciation helps them also in a big way. So I would rather look at two-wheelers, which I think there is a traction in India as well, and look at these companies because they benefit. Again, it's pretty much the same logic. It flows directly into their bottom line. The amount of depreciation multiplied by the amount of export they're doing gets into their bottom line. So it's a windfall for these guys, and they do benefit. Pharma, yes, they do benefit. Anybody who exports does benefit. But you have to also remember that, while we are talking about textiles, they have a huge issue in terms of 50% tariff, which US has imposed. So yes, to an extent, their competitiveness, improves, but the tariff barrier is humongous. So I'm not sure of the exact dynamics. Probably we'll have to look at company-wise and find out their exact component of their total exports going to US and how much getting affected by tariffs and what is the corresponding benefit of rupee depreciation. But those are very detailed analysis, and it will be difficult to immediately determine that. And at this stage, I think I will continue to avoid textiles. If I have to look based on depreciation of rupee, I will go to buy two-wheeler stocks. It's a little unlikely choice, but that's what I'll do.
Nice. Interesting. So, Sudeep sir, also help us understand, like we began by understanding from you, we are looking forward into the new year. Give a view to our viewers where they understand what kind of a template should they be working with as they enter the new year. At the start of 2025, of course, the budget announcements were quite impressive with respect to reforms with related to taxation, but despite that we did not see a humongous move on the markets. All through 2025 we've seen direct, indirect tax, maybe income tax laws also getting changed, so the government has done its part there. We've also had a lot of election focused momentum in the markets all through this year 2025, so political impact has also been seen, but largely what you pointed out, the markets have only been volatile looking at every tweet, every message that came out from the US when it came to the US-India trade tensions. And this entire year has passed out without any resolution on the same. And we are entering the new year with that uncertainty still looming large on us. So as we enter to the new year, what is the template that investors and traders must work with? What is the strategy that will work with for them, sir?
Well, I think one has to remember one basic fact that India, give or take, half a percentage this side, that side, is going to grow by 7 to 8%. That's the GDP growth we are, definitely going to see. And this, by far, will be the fastest growing large economy in the world. So that's one given fact. On top of that, you will have, I think, inflation is at record low now, but RBI will ensure that we are close to that 3.5-4% inflation rate, because that's the healthy thing to do. So we are looking at 11% kind of a nominal GDP growth during the next calendar year. And that nominal GDP growth of 11% will result in better companies, well-performing sectors, delivering 15% plus return on a yearly basis. Now, this kind of return, if you are ensuring, I think that's the best asset class to provide the kind of return. Forget what gold and silver has done last year. I don't think there's going to be a repetition of that. So if you have to invest, you should invest in equities, you should invest in good quality stocks and remain invested. There is fundamentally no problem with Indian companies, just that the valuation had reached a certain level when we started 2025, and the time correction was bound to happen, and that's what pretty much we have seen during 2025. Now, assuming there had been a trade deal and things had worked out the way we were envisaging, market probably would have continued to rally, but the time correction would inevitably come at some point of time or the other. It has already happened and happening as we speak, but this time correction will ensure that most Indian companies start trading at a PE multiple which is more palatable compared to what it was, say, 1 year back or 6 months back or even 3 months back. So things are improving as far as Indian market fundamentals are concerned. At some point of time, FIIs will definitely start coming to India, and remember that their holding in India is at record low level. Now, we have been sustaining at these 25,000-26,000 levels with domestic inflows and massive FII outflows. Now, assume a scenario where domestic inflows kind of continue and FII start pouring money. Now, market will definitely take wings and move to a completely different level. So there are possibility of market moving very, very fast in a short span of time as soon as we see some positive in trade deal. So you have to keep that in mind while you are investing in the next calendar year. You have to keep in mind that fundamentally there is nothing wrong in India. You will get your 15-20% return depending on the stock and the sector you choose, which probably will be the best in class. Now, under these circumstances, my advice and request to investors is pick up good stocks, stay invested. That's the mantra.
That's the mantra. All right. Okay. Let me also just point out to a few other moving parts that we can probably address when we enter into the new year. The one part that we would probably be monitoring even into the new year is how the auto sector is going to still continue to seek the impact of the GST rationalization, because in the previous quarter the impact was very limited. It had just started off. In the current quarter, most of the auto companies have said that there will be a mixed response to both the wedding related demand as well as the GST cut related demand and the festive demand. In the new quarter, the first quarter of the calendar year, 2026, is something we will actually see the impact there. So auto space is something that I wanted to seek your understanding as to how should one be approaching it. Also, there has been some indication that some companies will be raising the prices now. So will there be also some offsetting of the impact of the GST cuts there? I wanted to understand as to how should one be looking at auto space.
Well, I'm very positive on the auto space, and I think we have started seeing the green shoots in the segments of the auto industry, which was definitely underperforming for a very long time, which is the lower end vehicles. If you see the November vehicle sales numbers, for after a long period of time, the lower end vehicles of Maruti started picking up in a big way. And that's the result of GST rationalization, income tax relief, and the festive season setting in. So I think that is one end of the market which was suffering in a big way. And as you know, India used to be a small car market and a mass consumption market. Till the time you see pickup in the lower end vehicles, overall industry doesn't start performing well. And we have started seeing that happening. So I'm positive, definitely. And you're right. The companies have done also a lot of things. They have introduced new models. They have upgraded their models. Of course, the GST benefit is being passed on effectively. The income tax relief is doing its work in the hands of the consumers. So I think it's good time. Exports, we just talked about in a different context. The rupee depreciation is encouraging the exports and benefiting the companies in more ways than one. So overall, I think we are getting into a scenario which is very positive for the automobile industry. Of course, you have to keep in mind the valuation at which the stocks are quoting and pick up accordingly. But from a long-term perspective, industry perspective, I'm positive at this stage. You can look at Maruti Suzuki, you can look at M&M, you can look at Bajaj, Hero Motocorp, TVS. I think all of them look good from a long-term perspective.
Okay, fantastic. I hope this has truly helped you out in understanding how to look at the auto space at large there as well. Let me also bring up some of the sticky issues that we've been facing in the last 1 week with related to aviation. We've seen IndiGo fall quite a bit. I want to understand from you, how are you approaching this stock now, sir? Especially because the company has now said that their operations are now getting stabilized. We are seeing fewer cancellations now. Of course, the delays are still being reported, but that may also eventually settle down. On the other hand, because of all the penalties, because of all the compensations that IndiGo will be extending to all the passengers affected, there's a key understanding that probably in the next quarter and next couple of quarters, there could be a sizable impact on the margins of the company as well. How should one be really viewing IndiGo into the new year?
Well, I'll be very cautious. In fact, look at telecom industry. The government has been bending over backwards to ensure that there is no duopoly, there is competition, and a lot of benefits are being given and will be given to VI, and rightly so. We can't have a duopoly situation where the customer suffers at the end of the day. Unfortunately, the same thing happened, it got played out in the aviation industry. The Interglobe, with a 65-70% market share, got into a problem, and look who suffered. The country suffered, customers suffered, and in a very, very bad way. So there is absolutely no rationale or reason why government will allow this kind of a monopoly, duopoly to flourish and survive. So they will take whatever steps possible to ensure IndiGo's market share comes down. And that's not a good news from an IndiGo shareholder point of view, IndiGo profitability point of view, and IndiGo valuation point of view. We have to remember that. And under the circumstances, I will be extremely cautious from a medium to long-term point of view on interglobe aviation. Short-term there can be some excitement based on kind of resumption of full schedule and things like that. But long-term, I'll be extremely cautious. The days of 65-75% market share and complete domination of the Indian airspace, from interglobe aviation point of view, I think is a thing of the past. I don't think we'll see ever a repeat of the situation which we got into by default. I think in last few months.
Absolutely. Well, right now at least there is some ray of hope. You can see 2.5% uptick on IndiGo at this point in time, but definitely cautiousness, as Sudeep ji has said, will continue even going forward from here. All right, time to thank you, Sudeep ji, but you may also stay tuned because we are going to be rolling out some special visuals for all our viewers to see. Your channel has won big viewers at the ENBA Awards 2025 edition. We had Business Today Television have managed to get 6 big awards at the ENBA 2025. The first award has gone to Siddharth Zarabi, the group editor of Business Today, for Easynomics, for Gold.
By Siddharth Zarabi. Anybody from Business Today who's here and would like to applaud? The winners are here. मैं चाहती थी आप लोगों के लिए तालियां बजे क्योंकि मुझे कोई दिख नहीं रहा है. Congratulations.
The Gold Award goes to...
Huge congratulations, Business Today, Easynomics by Siddharth Zarabi. Huge congratulations on the win, the gold, Business Today, Easynomics by Siddharth Zarabi. Anybody from Business Today who's here and would like to applaud? The winners are here. मैं चाहती थी आप लोगों के लिए तालियां बजे क्योंकि मुझे कोई दिख नहीं रहा है. Congratulations.
All right, viewers, we have actually won a lot of awards there at ENBA. Our show Market Masters, which is anchored by Shail Bhatnagar, has won a bronze. Market Guru, that I have anchored throughout last year, has got a silver award. The opening show of Market Today has got a gold award at the ENBA. We've also seen Siddharth Zarabi emerging as the best business and finance journalist for both English and Hindi. He's received the gold award, and I have also received the best anchor for business English award as well for gold. So thank you so much for continuing to place your trust in Business Today Television. These awards are not just mere recognitions, but they are bigger responsibilities, and they ensure that we will raise the bar yet again, continue to get you all that you need to know to empower your decisions as far as your investments are concerned. So thank you so much, viewers, for consistently trusting your favorite channel, Business Today Television. Stay tuned, market coverage on the other side.
For 25 glorious years, Business Today Golf has defined the legacy of corporate golfing.